Welcome back to JPX Energy Market Weekly Updates. Earlier this week, oil prices maintained July's firm upward momentum and held the ground about $80 a barrel, underpinned by supply-side constraints, soaring refining margins, and improved demand outlook. The optimistic view of oil demand growth stemmed from likely fiscal stimuli by China to kickstart the economic recovery, as well as falling inflation, which could signal an end to interest and rate hiking cycle. This Wednesday, however, oil prices edged significantly lower on signs of profit-taking as the micro-risk trading started to rear its head again. New numbers from the government fiscal data system show the country's total public debt hit $32.6 trillion by the end of July. That's an increase of $276 billion in the last month. Fitch Ratings downgraded its U.S. debt rating from the highest AAA rating to AA+. It's once again unnerving those in financial markets who say these unsustainable deficits could trigger a dollar crisis, a steep rise in interest rates, and a sharp depreciation in the exchange rate and a wave of high inflation. In the fiscal markets, due to OPEC+ cuts, the prompt Dubai structure held up at firm levels over the week, with the October and December spread hovering at around $2.20 a barrel. Benchmark Dubai continues to trade at premium to Brent. Coming into focus this week is the October 4th meeting of OPEC+ ministers to review the market. Crude oil market has also been underpinned by a surge in refining margins, although the strength in margins appear to be more supply-driven at the moment. After adjusting for the impact of inflation, real margins are at the highest level for almost 8 years since 2015, which would encourage high levels of crude intake. The initial strength in margins was driven by middle distillates, mainly diesel and jet fuel kerosene. Middle distillates have started to tighten since early July on falling European stock levels, refinery outages, and a plunge in China's export, underscoring its vulnerability to supply disruptions since cutting off imports from top supplier Russia. Whether we look to Europe, the United States, or Asia, middle distillate stocks are low, causing sales prices, cracks, and intermonth spread to surge in the last 2 weeks. There is not much scope for rebuilding depleted diesel stock totally from the West, as U.S. refineries are already operating at a rate around 94%, the highest since 2015. It's more likely that China and India or the Middle East producers could provide some relief. In fact, improved export margins, especially gas oil for Chinese refiners, is supporting the incremental outflow. Oil product exports are estimated to jump 64% month-on-month to about 3.8 billion tons in July. Refineries have been increasing output, with the average operating rates at around 80% in July, up 2.5 percentage points from June. However, accelerating refinery processing will simply push the shortage upstream from the fuel markets to the crude oil market. As a result, it's likely the benchmark Dubai will continue to show its relative strength compared with other crude oil benchmark prices. Okay, that's all we have for this week. Welcome back next week.